you very much, and thank you, Governor Macklem and Deputy Governor Rogers, for joining us here today. One of the things that and we were talking about this a little bit earlier in terms of wage growth being considered as a factor in inflation. We talk about price increases, but I'm wondering, and I looked at the report that you put out not that long ago, where profit growth factors into the analysis of the Bank of Canada. There's been several studies out in the last 4 weeks or so that indicate a very extraordinary rate of profit growth in Canada's corporate sector among a number of different industries, showing a much higher rate of profit making compared to 2019 before the pandemic. I think David McDonald at the Canadian Centre of Policy Alternatives has estimated that that those increased corporate profits might be responsible for up to about a quarter of inflation in the Canadian context at the moment. So, not having seen a discussion of corporate profit in your report, I'm wondering if you're tracking that, where it fits in the framework, and what reflections you might have for the committee today on the role of price increases that go beyond increases in costs to companies that are delivering goods and services in the Canadian economy.
Yeah, I'll make a few comments there. Well, first of all, economy's strong. And that means, yes, profits, when the economy's strong, companies tend to do well. Profits are healthy, wages are going up. We do look at how income gets divided between labor and business, and you clearly want shared prosperity. The other thing I would say is that, and this gets to the price increases. For a long period before the pandemic, so we regularly go and we talk to businesses, we survey them. We have a quarterly business survey. And one of the questions we ask them when they get increases in their input costs, we ask them, are you passing those on to your customers? And typically what they tell us is that, well, yes, there's going to be some pass-through, but competition is really tough. Our customers are very price sensitive. It's very hard to pass those through, so there's very little pass-through. Currently, against a background of an economy that's moving into excess demand, against a background of an economy where prices are increasing overall, what we're hearing is companies are telling us they're passing through price increases more quickly to consumers. And that the best way to deal with that is really to get inflation down, to really reestablish price stability. To get, just let me finish. I mean, one of the benefits of low stable inflation is that then price increases stand out and consumers react and businesses are sensitive to that. That's one important reason why we need to get inflation back, and that's why we're raising interest rates.
I mean, when we hear that corporate profit margins averaged 9% in 2019 and now are averaging 16% in 2021, I mean, that seems like more than passing on rising costs to consumers, because the profit margin wouldn't be increasing at such a high rate if it really was just a case of passing on costs. Those costs would eat up the additional revenue if there was a one-to-one ratio of increased costs to increased price. So clearly, with an almost 50% increase in profit margin over the last 2 years, those price increases are more than passing on increased costs to consumers. There's quite a bit more happening in there. And of course, if you break it down by industry, there's going to be differences. But there are several industries where there's a pretty strong profit growth by significant amounts that would seem to dwarf whatever their increase in costs are. Or presumably, there would be no increase in profit if consumers were just paying the additional cost of the company and delivering the good or service.
Yeah, well, I mean, as I began, the economy is strong. Businesses see strong demand for their products. That gives them pricing power. Their profits tend to be are normally quite pro-cyclical, and we're in excess demand. We need to moderate. We need to moderate spending. We need to bring demand and supply in line, and that's the best thing that's the best way to re-equilibrate the situation.
But where significant price increases or significantly larger profits are behind price increases, and it's not just a case of passing on costs, those price increases are part of the inflation story, are they not? I mean, if companies are taking an opportunity in the market of reduced competition because of interference with global supply chains or whatever the reason may be, that they have more pricing power in this current market. And part of that is just elevated demand, particularly for goods, because people haven't been able to spend on services to the same extent. But in that context, if companies see an opportunity to increase their profits, they will also be increasing inflation. So it is part of, or ought to be part, I would say it's not really part of the narrative that's been told about inflation. But if those exceptional price increases and profit growth are responsible for up to 25% of the inflationary package that Canadians are experiencing in their current budget, surely, while I respect that that's not something you can deal with from a monetary policy perspective, ought it not to be an important part of the narrative, so that when government is looking at its fiscal policy and other measures, they're sensitive to the fact that that may be going on and feel an obligation to take action?
Well, look, let me be clear. My message to companies is that they should not expect current rates of inflation to continue. That shouldn't be reflected in their pricing decisions. We've been very clear. We are raising interest rates. We need to raise interest rates to slow spending and bring inflation back, and that's what companies should be expecting as they take their pricing decisions moving forward.
Thank you, and thank you, MP Blaikie. That's the time.